Friends, happy evening to all of you. I welcome you all to this important CP meeting on valuation under income tax. Few days back, when I checked with the speaker as to what are the topics we could kind of don't, we drilled down to this valuation. Probably the speaker today is somebody who can speak on various important topics, and I thought what is more relevant and contemporary, we thought we will take up. In fact, there was a choice to speak on opportunities for chartered accountants under this valuation, but then we thought, no, let us go with a technical topic and reserve the topic for some other day so that our members can also know that the certificate course on valuation is kind of gaining momentum, and in the near future it is going to have a lot of practice area where it will be required, because many times the certification from the value will be required. So today we have joining with us CA Gopal, Krishna, Raju, past regional council member, who is kind of he wears multiple hats when it comes to discussing on the topics. And also joining with us we have CA Naresh Chandra Gelli, regional council member, and CA Abhishek Murli. So before I request Dr. C. Abhishek Murli to introduce the speaker, I request CA Naresh Chandra Gelli to share his thoughts and also kind of coordinate the session, because I may not be available full time for this session. Gelli sir, over to you.
Chairman of SIRC, DCJG, and Secretary Abhishek Murli, my good friend Gopal, Krishna, Raju, and all the members, good evening to all of you. Before I would like to first congratulate the Chairman and Secretary for working so hard and getting the All India Best Region Award on All India basis. That's a great achievement. Though we are part of the, but you two guys have worked very hard, and so the amount of knowledge and information sharing through the Zoom at time we had constraints in terms of having a physical using technology was the best part. DCJ being a technology person, to a very great extent. Now, friends, coming to Valuation and Income Tax Act, which is a very important aspect of our in our daily of our practice of tax laws, and I think GK will take us through in detail about the issues on valuation methods and the various where we as a professional should comply with requirements. I think can't go much deeper into it. Welcome GK Raju for willing to come and share about the topic. And he's a mass subject, and he has a lot of others also which he can link to evaluation. So I'm sure we'll have a great time to it. Thank you very much. Thank you, Chairman, for giving the opportunity.
Thank you, Gelli sir, for giving an excellent prelude to the issues which kind of the beloved speaker is going to cover on valuation. Abhishek, you can formally introduce the speaker and take things forward.
Thank you very much, Chairman of SIRC, CA Dugarchan Jain, my fellow council colleague, and very vibrant and senior most council colleague, most experienced CA Naresh Chandra Gelli sir, joining us live from Hyderabad, and of course the speaker for the day, CA Gopal, Dr. CA Gopal Krishna Raju sir, who's joining us here, and of course all the participants. It's a pleasure for me to introduce a good friend, Dr. CA Gopal Krishna Raju. And I straight away go into his profile, as the prelude has been rightly given by Naresh Chandra Gelli sir. He's a practicing chartered accountant from Chennai and hails from a family of chartered accountants. He served for 3 terms as a member in SIRC and has an honorary doctorate in governance of GST in the government sector by St. Mother Teresa University, Melbourne, Australia. He is also qualified in the Independent Directors Exam and holds a host of variety of various qualifications, include valuation, insolvency, member of the Cost Accounting Institute and company secretary. He has done a twin postgraduate diploma in operation research and various others. He has authored 2 books, First Lessons in Information Technology and Standard Costing, and is a regular speaker as well. Speaks on information technology, finance and taxation, and is a visiting guest faculty in many institutions, corporates and schools. He has been a nominated member of various committees and various colleges and professional bodies. and also is a versatile speaker, spoken more than 500 seminars on GST. So thank you so much, Raju sir, for accepting our invitation to be here today. We welcome you, sir.
Thank you.
Raju sir, over to you.
Okay. So can I share the screen here? Yeah. So hope the screen is visible now. Right.
Yeah, very much, very much.
Thank you. Thank you. The dynamic chairman of Southern India Regional Council, and I must say a technology chairman, especially he has proved his mettle and his entire year, despite the kind of pandemic. Southern India Regional Council has been able to reach nook and corner of not only southern region but also across the region. And I'm sure that is the only thing which has made the Southern India Regional Council to bag the coveted Best Region Award. So my congratulations to Chairman Dungar, and ably supported by the charismatic secretary, I must say, Dr. C.A. Abhishek Murli, who has been very, very supportive and with a smiling face and I must say the James Bond attire. He takes the members' attention and invites the members' attention, and the kind of dedication he has been showing in all the programs. I'm sure he'll be climbing the ladder, and he will definitely reach the pinnacle of success. My best wishes to Abhishek Murli. And C.A. Naresh Chandra Galli, my very good friend, old friend in the regional council. I always remember him, the kind of down-to-earth personality, and the kind of friendship which we share for so many years. And I am reminded of those warmth. Thank you very much, Mr. Gelli, for joining today. And all the 200 plus members who have been virtually connected to this particular program, my warm greetings and good evening to each and every one of you. I must at the outset thank SIRC for giving me this opportunity to share my thoughts today on valuation under income tax. Yes, I'll just reduce this. Yeah. Yes. So valuation under income. Yeah. Good. So before I start my session in this particular topic, I want to make one observation. What is that? Under Income Tax Act, valuation has been referred in various places. Maybe I'll just share with you. These are all some of the sections under Income Tax Act where the significance of valuation has been mandated, and also the rules. Section 56 to Rule 11U and Rule 11UA, and right from 222B onwards. So I've just captured a snapshot of this valuation under the Income Tax Act. Now, this topic is gaining importance day by day, and recently, especially last financial year, last budget, budget 2020, there is a very important amendment also that has been brought out, especially with respect to cost of acquisition as of 1st April 2001. So all these has a direct bearing on the revenue part with respect to Government of India. Now, today's topic I'll be totally focusing on maybe on one particular aspect, and to the extent possible, if time permits, I'll try to share my thoughts on other provisions also. But I want to cover this particular area, 5627B, and the respective rule. 11U and 11UA. This is a section with respect to valuation of shares, especially for private limited companies. I repeat, valuation of shares for private limited companies. Whenever there is a sale of share of one of the shareholder to the maybe to the existing shareholders, or they may invite a new investor where the sale price, otherwise called the issue price of the equity, will not be face value, will be above the face value. So if that is the situation, let us take the face value is 10 rupees and issue price is 90 rupees. So what should happen to this 80 rupees? Should it be treated as income? All these years, over a period of time, especially before introduction of 5627B, I must say before introduction of 5627B, the logic was anything above face value should be taxed. No, it is only in share premium. How can that be taxed? It is only a capital receipt. So there were all kinds of arguments, and you have decisions both sides. So to put a full stop to those dichotomy, this provision was brought in 5627B. But after this, there has been quite a number of litigations, and I will come with a very important. I will share that this is one recent decision of Income Tax Appellate Tribunal, Jaipur bench. So which is on 9th of October 2020. So I'll come to this particular decision a little later. A little later I will come. So I'll share with you some of the settled issues also on this particular aspect. So I'll first try to share with you. I'll open up the concept of valuation under Income Tax Act first. Now, first point what I want to drive after this mini introduction is, should this does this valuation under income tax law come under any regulation? Is it being regulated? Are there any regulator who oversee the valuation under Income Tax Act? Answer is no. Number two, apart from this, you also have a valuation officer under the Income Tax Act, which is a department valuation. So whenever the assessing officer is not satisfied, or they use a word called opinion, when assessing officer is not satisfied or he is of the opinion, then he may refer to the respective valuation officer under 55A. Good. Now what the valuation officer will do? Now there are two aspects where valuation is important. Why this subject is important, let me tell you. One is sale price, another is cost price. Let us assume for a time being the property sale price. Now after 50C, things are settled. Things are actually settled. Now, what if the stamp duty value is 2 crores and the actual consideration is below 2 crores? We now have a settled provision which says that the gap cannot be more than originally it was stamp duty value, then they relaxed to 5%, now they relaxed to 10%. Good. Now what if the actual consideration is above the stamp duty value? That is the sale consideration. Number two, in that itself there will be a no, it is not 2 crore. People say it is 5 crore, 5 crore. You are only saying 2.5. We don't agree. I will take 5. Then if they have to take 5, so that means there is a cash component is involved. Okay, that is what the presumption of the department, which has not been recorded anywhere. Can they go for a valuation, and whether the valuation officer's valuation report, can it be final? So these are all aspects with respect to capital gains. Now I'll come to the concept of cost here. Now, people, when they think that, okay, the gap between my cost price and selling price is capital gains, cost price, if it is higher, the gap is reduced. The gap is reduced. Especially, you have the base year. What is base year? 1st April 2001. 1st April 2001. If the acquisition is before, if the purchase date is before 1st April 2001, should I have to take the purchase cost or should I have to take the fair market value as on 1st April 2001? Shall I take whichever is higher? What is the new proposition after this base year change? Now, here people will prefer to go for a fair market value. Now, what is the cost? I have bought 20 years back, I have bought 25 years back for 10 lakhs. Okay. And I'm now selling that property for 4 crores. Where is 10 lakhs? Where is 4 crores? Now, as on 1st April 2001, I don't know the value. If the fair market value is 50 lakhs, I'll get indexation from 50 lakhs. If the fair market value is lesser than 50 lakhs, only from that I will get the indexation. So naturally, the assessees will be interested to know what is the fair market value, what will be the tax saving I can make with respect to the fair market value as on 1/4/2001. So valuation with respect to selling price. So concept number 1, sale consideration. Also, valuation is an important topic. Your cost of acquisition, COA, cost of acquisition also, there is a significance of valuation. So let us first be clear about this. Now, I am now taking you into 56.2. Okay. So I'll come to all this maybe a little later. Recently, the budget 2021, the 45.4, I repeat, 45 subsection 4 has been replaced. And you also have a new section that has been introduced called 45.4a. And both these provision, they actually give a revised outlook with respect to calculation of capital gains whenever there is a retirement of partner or reconstitution. Okay, whenever there is a dissolution or reconstitution. Okay, so where retirement will be there, admission will be there, all this stuff. So I will first take you into so concept number 1, valuation is an important topic with respect to sale consideration, cost of acquisition, and there are a lot of places. So I will take this as second thing. There are innumerable places where the significance of valuation is relevant. Okay, with respect to sale consideration, with respect to cost, where and all. That is a list of sections which I have listed here. Okay, 50C, 50CA, D, 51, 55.3, 55A, 56.2, all these sections. Maybe I may not have time to cover all these provisions. So that is why I'll take one very important area and I want to discuss that fully and thoroughly. Good. Now, let me first take you to second point which I want to share with 56 subsection 2. This 56 subsection 2, if I have to remind your memory, it actually starts the subclass 5, 6, 7 and 7A is not applicable now. So it is only 56.2 subclass 1, 1A, 1B, 1C, 1D, 2, 3, 4, and after that 4, 5, 6 and 7. This was with respect to individual and HUF. So if you look at the class number 5, they originally started from 2004 to 2006, where they started with 25,000, then they increased to 50,000, and they introduced the firm and company through 7A, and now they merged all these 4 sections together, and they have introduced the section called subsection 10. So 56.2 subsection 10 will speak about the gift, whether in cash or in kind whether it is immovable or movable. Okay. Now, there also there is an element of valuation involved. And to start all this, kickstart all this, I'm going to start with a section called 222B. So this is my third point. So let us understand what is 56.2, and wherever you go on entire Income Tax Act will only speak about value means fair market value, FMV. They don't speak anything other than FMV. Now here I want to mention one particular point. What is that? Ind AS will speak a language called fair value. GST laws will speak a language called market value. Okay. Ind AS will speak the language called fair value. GST laws will speak the language called market value. Income Tax Act will speak the language called fair market value. Wow. So this is our first, I'll call it as concept number 3. Okay. What is fair market value? Because from now onwards, the entire next 60 minutes to 90 minutes, I'll only be speaking about one term called fair market value. Fair market value in relation to capital asset means the price that the capital asset would ordinarily fetch on sale in the open market on the relevant date. So there is one version of fair market value is market price. Please look at this. Price that the capital asset would ordinarily. These are the words you will definitely see in the definition of market value, in the definition of fair value. Many of the words are common with respect to all the three, but all three are not same, all are different. All three are different. Fair value is a concept applicable only for recognition in your books of accounts. For recognition in your books of accounts, the concept is fair value. Market value is for what is your transaction price. And fair market value, the main purpose is to decide both the sale consideration, what you actually receive, and also your cost. So therefore, fair market value in relation to capital asset, that is with respect to capital gains, means price that the capital asset would ordinarily fetch on sale in the open market on the relevant date, that is the transaction date, and where the price is not ascertainable, you don't have a market price. I am actually selling an antique piece. Okay, that is why if you go into the rule, you will have very interesting rules which will speak about jewelry, archaeological collections, drawings, paintings, sculpture, work of art, shares and securities. So I'll just share with you the respective rule, because I'll be referring to the respective rule also every now and then. Okay, so that you can parallelly have a this is your rule 11 UA, determination of fair market value. This is what I was referring to for the purpose of 56, because section 56 will refer to, you go to rule will speak about fair market value, because this 222B is in relation to capital asset, and therefore it is in relation to the capital gains. But then what will you do with respect to income from other sources? Because we are now going to discuss about 56. 56.2, whether shall I go for 222B? No. 56, they say you go to rule. Rules speaks about like this. For the purpose of 56, fair market value shall be determined in the following manner. So, for capital asset 222B, for 56.2, rule number 11 UA. Okay, good. So this is the first message I want to share with all of you. Now, before I take you to the next step, okay, before I take you to the next step, I want to make one observation. What is the observation? Who will do the valuation? Who will give the fair market value? Do you have a separate a vertical, a professional, or do you have a separate a group of a bunch of people who will actually be called as valuers? They will only have to give. Actually, nowhere in the law, especially in the Income Tax Act, they speak about valuers. But there is a reference which I want to give, and that particular reference is, one is valuation officer, another is the registration of valuers, which is not in the word valuer is used in Income Tax Act. And the moment they say valuer, they say you have to go to Wealth Tax Act section 34AB. All of you may wonder one thing. Oh, valuer, valuation, fair market value. And the moment you say valuation, who should do valuer? Who is that valuer? That valuer should be in the list of register of valuers maintained by the Chief Commissioner or Director General. He will maintain a register of valuers. And this is under the 34AB of the Wealth Tax Act 1957. Wealth Tax Act is repealed. Is it still live? It is still live with respect to certain procedures. That's all. Not with respect to assessment of wealth tax. Not with respect to assessment of wealth tax. So the life of valuation is still there with respect to the breath. Now the oxygen is still there with respect to the fair market value, valuer, valuation. It is still there. And the 34AB is still breathing. The oxygen is still there. Life is still there. The register of valuer is still maintained. And all over India, how many people are like that? The number of people who are there in the register of valuers does not exceed 10,000. It is only hardly 9,000 plus. Okay. Can you and me, can a chartered accountant find a place in register of valuers? As actually, yes. But do you need to actually find a place there? I will say no, because the law gives us recognizes us as a professional, and as a chartered accountant, whatever the valuation report or the value, I will not call that as a certificate, I will call that as a valuation report, is actually recognized. So I'm just going to share with you all those aspects one by one. So now let me take you to good. Please look at this. 224. Slowly I'm taking into the respective provision called 5627B. So first of all, I want to make this point very clear to all of you, that in section 224.16, in section 224.16, please look at this. Any consideration received, please look at this word, for issue of shares as exceeds the fair market value will be treated as income. So now I am going to give you an example. The face value is 10 rupees. Face value is 10 rupees share, but you are issuing it at 90 rupees. You are issuing it at 90 rupees. So what is 80 rupees? 90 minus 10. 80 rupees is securities premium. Maybe in the old Companies Act, it is called share premium. The new Companies Act 2013, it is called securities premium. This 80 rupees, is it taxable? Answer is, you have 224.16. It says consideration received in excess of fair market value. So the fair market value is 45. 10 rupees face value, fair market value is 45, and the issue price is 80. So consideration received exceeding the fair market value. So exceeding 45 rupees. So 80 minus 45, 35 rupees will be treated as income. Okay. Under 5627B, that will become income from other sources. Okay. Taxable in the hands of who is receiving? Company is receiving. Who is the recipient? Company is recipient. So company has to pay tax on the surplus received, excess of consideration received in excess of fair market value. So what is the corollary? What is the moral of the story? Why should I receive above fair market value? Now, what is fair market value? Okay. So 224.16. So now I'm taking you to 5627B. So what is 5627B? Please look at this. 5627B. So I'll take you to the section also every now and then, because 55 I will come, but I will also share with you. I'm sorry for that. So this is 56. Okay. So this is your income tax side, and you have the latest provisions here. So since the font is very small, I will directly take you to the slide here. So 56 to 7B. So this 7B starts from here, okay, and ends here. Ends here. So this is what I'm going to discuss. 7B. This is 7B. Where a company not being a company in which the public are substantially interested. So we have a definition under section 2, which is a company which is not in which the public are substantially interested. Not being a company in which public are substantially interested. So all private limited companies. Okay, good. So I'm not taking you to that particular definition. We have a definition of a company in which public are substantially interested. Definition is there. Okay. So where a company not being a company in which public are substantially interested, example, private limited company, receives. So a private limited company receives in any previous year, for example, in the financial year 1920 or this financial year 2021, from any person. Who is any person? I'll receive from shareholder. Who is a shareholder? Individual can be a shareholder, minor can be a shareholder, firm can be a shareholder, company can be a shareholder, society can be a shareholder, trustee can be a shareholder, from any person, but only resident. 56 to 7B is only applicable for resident. The moment non-resident is there, FEMA also applicable, Income Tax Act is also applicable. FEMA also applicable, Income Tax Act is also applicable. So you have to first satisfy FEMA, and both comes under Ministry of Finance only, but you have one is Income Tax Department, CBDT, okay, another is your Reserve Bank of India, which regulates through FEMA. So this is a section with respect to issuing shares to a resident. Any consideration for issue of shares that exceeds the face value of such share. Okay, so 10 rupees. You may wonder, just now visa exceeding fair market value, but here they use a term called exceeds face value of shares. So now I want to make one point very clear. If I issue at face value of shares, nothing. Keep quiet. No need for any valuation. That is what department also wants it. Issue at face value. So exceeding face value, the aggregate consideration received for such shares as exceeds the fair market value of shares. The aggregate consideration. Now, why do they use the word called aggregate consideration? You will give in piecemeal. That 80 rupees, 90 rupees, what I said per share. 10 rupees is your face value. 45 rupees is your fair market value. Okay. And maybe 80 rupees is what you have actually issue price. 80 minus 45, 35 is actually taxable. But that 80 rupees you will not pay in one shot. You will pay 20 rupees first, 20 rupees next, 20 rupees third, 20 rupees fourth. So installments you pay. That is what's called aggregate consideration. Aggregate consideration received. So this year you pay 40, next year you pay 40. Which year that is taxable for the company? Aggregate consideration received. That is why the word they say consideration received exceeding the fair market value. So the year in which you receive exceeds fair market value. This year I receive 40, I need not pay tax. Next year I receive the balance 40, 35 I will have to pay tax. Okay. Now these are exceptions for venture capital company and a notified company. So I'm not going to read that particular class. Okay. So both this provide proviso, I'm not going to discuss. I'm not directly I'm going to the explanation. Very, very important explanation. So 56 to 7B explanation. 56 to 7B and 22, 24, 16 both reiterate the same point. Okay. So what is 24, 16? Consideration received exceeding fair market value. What is 56 to 7B? Consideration, the aggregate received exceeds fair market value. Then what to be done? Okay. So what is this 56 to 7B? 56 to 7B says the following income shall be chargeable to income tax. This is the starting point of 56.2. Following income shall be chargeable to income tax under the head income from other sources. What is the following income? Any consideration aggregate received exceeds fair market value. So that is why they first give that in income and they confirm that in the charging section. Okay, good. Now come to explanation. What is fair market value? For the purpose of this class. So that means for the purpose of this class. Why I mentioned this? I started with the 222B fair market value. Will you go to 222B fair market value definition? No. Because 222B fair market value is in relation to capital asset, that is only for capital gains. So whenever, because after my discussion, I will also take 1 or 2 examples of capital gains also, if time permits. Okay, there then at that point of time, I will come to the 222B. Now, for the purpose of this class, that means 5627B, the fair market value of the share shall be the value. Now, please be very clear. Please be very clear. Fair market value of the share shall be the value as may be determined. I want all of you to pay your kind attention. As may be determined with such method as may be prescribed. Oh, very important. Remember, guys, the word prescribed means under rules. Prescribed means under rules. Rules only I will prescribe. Okay. Specified means regulation. Actually, there is no regulation for income tax. Generally, for Securities and Exchange Board of India, specified will come because regulations are there. Because they are specified will come. So here prescribed. Prescribed means rules. So fair market value determined means computed. Okay, ascertained. Okay, determined in accordance with the method. Such method. No, what is that method? Okay, with such method. So I want all of you to pay your kind attention here. I am going that method is given in rule number 11 UA. I am going for that method. As may be prescribed, or very important, or. So I may go by the rule, or as may be substantiated by the company. Only company. I want all of you to pay your kind attention. Substantiated by whom? By the company. Then who will do the valuation? Company will do valuation. Number 1, company will do the valuation. I repeat. That means internally I can ask one of my employee to do the valuation, or I can engage an expert to do the valuation and get the valuation report. That is substantiated by the company. So I will have an expert's report. Who's that expert? The chartered accountant. Who's the expert? The chartered. Nowhere it is mentioned. Nowhere it is mentioned in our. I want all of you to please pay your kind attention here. In A1, okay, the explanation A1 says prescribed. Then I will go to rule. Or as may be substantiated by the company. I can take a choice. Nowhere they say that you should only go by the prescription. Okay, as may be substantiated by the company. But here one interesting point is there. To the satisfaction of the assessing officer. I don't know from where they got this word. Many of the officers they interpret this in a very different way, but all of you know what it is. So as may be substantiated by the company to the satisfaction of the assessing officer. Okay, so that means that report I will give. He will say no, I won't agree. I won't agree. 45 rupees I don't agree. I say fair market value is only 15 rupees, 15 rupees, because 80 rupees you have got. 45 minus 80 is gap is 35. 15 minus 80, oh, gap is more, no? Okay, gap is actually 65. So therefore, instead of taxing 35 per share, I will tax 65 per share. Okay, so as may be substantiated by the company to the satisfaction of the assessing officer. Now, what if the assessing officer is not satisfied? 55A. 55A. Now, please look at 55A. But I want all of you to please pay your kind attention. This 55A is applicable only for capital gains. So I cannot go for capital gains. I cannot refer to valuation officer. With a view to ascertaining the fair market value of a capital asset for the purpose of this chapter. Okay. This chapter means the entire chapter of the, what do you call it as the computation chapter. Okay. Under that heads are there. One of the head is, okay, with a view to ascertaining the fair market value of a capital asset for the purpose of this chapter. So here they are very clear about the FMV of a capital asset. The AO may refer the valuation of a capital asset to a valuation officer. Now, can the assessing officer refer to valuation officer under 55A? I will say no. He is only going overboard. He is going overboard. He doesn't have. He need not refer actually, because I am in 55. Sorry, I am in 56, not in the particular head of income. So, as may be substantiated by the company to the satisfaction of the assessing officer, based on the value on the date of issue of shares of its assets, including, very important, intangible assets being goodwill, know-how, patent, copyright, trademark, license, franchise, or any other business or commercial rights of similar nature. Please look at this. Based on the value on the date of issue of shares of its assets, including issue of shares of its assets, including, for example, he may give, there is a situation 1, cash transaction, situation 2, non-cash transaction. What is situation 1? 10 rupee share issued at 80 rupees for cash. So then fair market value is 45, balance taxable. If fair market value is 80, I am collecting only 80, nothing taxable. Now, what is coming in? Cash. Now, what is coming in will not be cash. What is coming in will be assets, including intangible, based on the value on the date of issue of shares of its assets, including intangible assets being goodwill, know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial rights of similar nature. So what will come in? Not necessarily cash. It can even be an asset. So then you have dual responsible. You have dual. What is the value? What is the value you are going to record in your books of accounts? What is this you are going to give? For example, instead of cash, there is an intangible asset that is coming in. There is a tangible asset that is coming in. What is the tangible asset? What is the value of the tangible asset? What you are giving? What you are giving is shares. You are not giving at 10 rupees. You are again giving at a fair value. So more the fair value, lesser the shares you will give. Lesser the fair value, more the shares you will give. So you are now caught between two things. Now two values are uncertain. One, what comes in. What comes in is cash, that value is known. What you have to give is only the fair value. Now what comes in is not a cash. It is actually a non-cash item. So please wait. I'm going to give some of the very interesting examples now. Whichever is higher. Wow. So as may be determined in the rule or substantiated by the company to the satisfaction of the assessing. So I will get even a valuation report, and whichever is higher. So as per rule 11 UA or the valuation report taken from an expert or even within the company, there will be a chief technology officer, there will be a chief finance officer, okay, there will be a financial expert. They may give a report. This is a company's valuation. For their own company's transaction, they do a valuation. Internal valuation can be done. External valuation, internal valuation. What is called internal valuation? Ind AS, measurement and recognition. Who will do? Management itself only will do. Ind AS, nowhere they mention that who has to do the valuation. So therefore, now I am coming for the very important question. Who will do valuation? Okay. There has been a lot of interpretations here. There is already one regulator called Insolvency Bankruptcy Board of India. That regulator, so far, the regulator has only been regulating 3 laws. Number 1, the Companies Act. Number 2, Insolvency Bankruptcy Code 2016. Number 3, SEBI. So valuation under IBC, valuation under Companies Act, valuation under SEBI. That too specified valuation under SEBI, specified valuation under Companies Act, and all the valuation under Insolvency Bankruptcy Code. will come under the purview of the Insolvency Bankruptcy Board of India. So a registered valuer, so far 3,846 registered valuers are enrolled with Insolvency Bankruptcy Board of India. Can we say they are an expert? Yes, you can. They are an expert. So they can also do the valuation under Income Tax Act for your kind information. Chartered accountant also can do, and non-chartered accountants also can do, because it is substantiated by the company to the satisfaction of the assessing officer. Very, very open. Now let me go to the prescribed rules. As may be determined in accordance with such method as may be prescribed. Okay, good. Now, first let me take you to rule 11 UB. Okay, so this rule 11U, I will share with you the rule number 11U here. This is rule number 11U. Okay, this is rule 11U. This rule 11U is giving meaning of expressions used in determination of fair market value. Okay, what is 11U? In 11U, you have various definitions. A, B, A is not there. B is balance sheet. C, D, E, F, G, H, I, J. Okay, and valuation date means the date in which the property or consideration, as the case may be, is received by the assessee. Okay, good. So I want to make one point. 11U. Rule 11U only speak about meaning. So this is a very important rule. So we are now at 6:48. I will take another 40 minutes time to cover this entire rule. After that, various scenarios I will discuss, various case laws I will discuss, and with respect to some practical illustrations also I will discuss. Now, this rule 11U defines what is meant by a balance sheet. Hey, what is this? Should balance sheet be defined? Theriyada. Okay, balance sheet na enna theriyada. Okay, theriyum. But please look at this. This is very important. Why? Because between two dates, two balance sheet, I mean between two year ends, there is a valuation, there is a transaction is happening. You cannot say that the transaction should happen only on an year end, because year end only balance sheet is there. So balance sheet is 31st March 2019 is there. Now 31st March 20 is there. Okay. Now transaction took place today. Okay. Transaction took place today, and today's date is 17th of February 2021. So 17th of February 2021, I am issuing 1000 shares at 80 rupees. Face value 10, fair market value 45. Okay. Now fair market value, how will I determine? Now what the section says? As may be determined according to such method as may be prescribed. They say in the fair value determination, you go to the balance sheet. Now which balance sheet? Please look at this. For the purpose of sub rule 2 of rule 11 UA. Okay. For the purpose of sub rule 2 of 11 UA. Okay. The balance sheet of such a company. Okay. As drawn up on the valuation date, which has been audited by the auditor of the company appointed under 224 of the Companies Act. Okay. And where the balance sheet on the valuation date is not drawn up. So, very important. What is today's date? 17th of February 2021. Now they are asking you want to actually do the valuation under rule 11 UA. Under rule 11 UA, they will say the assets as per the balance sheet. Balance sheet as on the valuation date. Or drawn up on the valuation date. Now you tell me, guys, you tell me whether on today's date whether a balance sheet is possible. It is possible. Naturally, it is a professional opportunity, and this is a professional opportunity we have to tap. Hey, I will give you prepare balance sheet, and please look at this, which has been audited. Auditor, that means separate fees. Audited by the auditor. So that is why 1 second auditor, 1 second fees are. So then what they should do? You know, this is again I need to prepare accounts audit up to 17th of. So what is the purpose of preparing a balance sheet as on 17th to 2020? Only for the purpose of your fair market value. and where the balance sheet on the valuation date is not drawn up. No, sir, that is not possible. It will take a lot of time. The balance sheet drawn up as on the date immediately preceding the valuation date, which has been approved and adopted in the AGM. So then the valuation, then the balance sheet on the valuation not drawn up. The balance sheet, including the notes, please look at this. Drawn up as on the date immediately. So drawn up as on a date immediately preceding the valuation date. Very good point. Very, very good point. So then which is the balance sheet drawn up as on a date immediately preceding the valuation date? Now I am on 17/2/2021. Maybe 31st March 2020 balance sheet would have been drawn up, approved and adopted in AGM. Please. Here they don't use the word called approved and adopted. If it is done on a valuation, only audit. I need auditor signature. I need chartered accountant signature because auditor appointed at 224. The same statutory auditor has to sign. So therefore, best thing is statutory auditors audited balance sheet as on 31st March 2020 or which has been approved and adopted. Because the moment you take 31st March, approved and adopted in AGM mandatory. This is mandatory. So approved and adopted in the AGM. Else, better draw the balance sheet as on 17/2/2021, get the chartered accountant signature. Matter over. Katham. Okay. So this is with respect to for the purpose of 11 UA2. Okay. Please remember 11 UA2. This is what. So 11 UA2 I will take you. Wait a minute for some time. Now, in any other case. Now, what do you mean by in any other case? You have 11 UA1C. So, please remember for the purpose of 11 UA, for the purpose of 11 UA2, in any other case, in what is this any other cases? Rule 11 UA 1C. I repeat the word 1 subclass C. I am always this bracket I have a this is rule 11 UA 1C. For example, I am telling you, so please note down this. So for the purpose of rule 11 UA 2, audited balance sheet. For the purpose of rule 11 UA 1C, now I am going inside 11 UA 2 and 11 UA 1C. Okay, good. In any other case, in relation to an Indian company, the balance sheet of such a company as done up to the valuation date, which has been audited by the auditor of the company appointed. So same point they are repeating. Okay. So in relation to Indian company, drawn up on the valuation date. Same point. So what is the difference? No difference. In relation to a company, okay, not being an Indian company, that is foreign company. Okay. The balance sheet of the company as done upon the valuation date, which has been audited by the auditor of the company, if any appointed under the laws in force of the country in which the company is registered or incorporated. So, with respect to rule 11 UA2 only, you can go before the valuation date. With respect to any other case, this is I am giving example. Okay, like, not only rule 11 UA 1C, but also other relevant rule also. I'll now go inside that particular rule. So, in relation to an Indian company, the balance sheet of such a company as drawn up on the valuation date. So, very important. I cannot go back. I cannot go back to the approved and adopted in AGM. So, I want a signed copy which has been audited by the auditor of the company appointed under the law relating to the companies in force. Now, this will take time. So that is why as may be determined or as may be substantiated. So that is why if this is possible, you can go for it. So now let me go into the subject now. Rule 11 UA 1C, rule 11 UA 2, what it says. Okay. Now before I go to rule 11 UA, rule 11 UA 1C. This rule 11 UA 1C, okay, has subclause A and B. Okay, subclause A and B. The subclause B refers to, I repeat, subclass B refers to unquoted equity shares. 11 UA 1C has A and B. That is why I have to show you here 11 UA. All of you please look at 11 UA. This is your 11 UA. Determination of error. Rule 11 UA 1C, valuation of shares. What is rule 11 UA 1CA? Fair market value of quoted shares. Okay, quoted shares means listed company. Okay, so I am not going for it. Now please come to 11 UA 1CB. Fair market value of the unquoted equity share shall be the value. Okay, so that is why I am coming for 11 UA 1CB, because A is for the quoted shares and the B is for unquoted equity shares. Okay, it is for unquoted equity shares. Now what is it? Unquoted equity shares shall be on the valuation date. Please look at this. On the valuation date. So what you have to do, today's date is 17/2/2021, of such unquoted equity shares as determined in the following manner. Now what is this following manner? Very simple. A plus B plus C plus D minus L into, it is not present value and all. What is this? PV, paid up value of such equity shares, divided by total amount of paid up value of equity shares as shown in the balance sheet. Paid up value of such equity shares and total amount of paid up equity share capital as shown in the balance sheet. Now both can be same, maybe if you have a category. Otherwise this is the fair market value of your unquoted equity shares, because sometimes what will happen, you may have category 1, category 2 equity shares, partly paid up equity shares, all this stuff will be there. So that is why that portion is given. So as such, this is only, you need to only remember this. Otherwise I will call this as net asset. Okay, I will call this as net asset. A plus B plus C plus D minus L. L is called liability. What is A? All of you please look at this. Book value of all the assets. Now how will you take all the assets book value? Now from where you will take the book value? It is already audited balance sheet. Unquoted equity shares on the valuation date. So what I will do? Book value of all the assets in the balance sheet. Now all of you please read this word called balance sheet. Okay. Now what is balance sheet? Balance sheet means 11 UB. Okay. For the purpose of rule 11 UA only, all drawn on the valuation date, audited, or the immediately preceding, that is 31st March. In any other case, this is any other case. What does balance sheet means? You have to take the balance sheet drawn upon the valuation date. Oh, that means audited balance sheet. I want audited balance sheet. On what date? Valuation date. So responsibility is casted on whom? Chartered accountant. Responsibility is casted on whom? Chartered accountant. Now, the fair market value is a combo of, I will call it as Kichidi. I will call it as Kichidi. So rule 11 UA 1CB. This is a Kichidi. Is it market value? No. Is it book value? No. Is it a combination of book value and market value? Yes. That is why I said Kichidi. Some of the places Kichidi will be very nice. It's actually dal bath. It is actually parpu sadam. Kichidi means what? Parpu sadam. Okay. With parpu sadam, with some vegetable, all these things, sambar sadam mari irukum. Adan Kichidi. Okay. So generally in Pongal and all, what they will do, they will put all the vegetables and they will put a Kichidi type one bisibela bath. It will be very tasty. Like that, your rule 11 UA 1CB is a Kichidi. Okay. What is A? Book value of all assets. Okay. Book value of all assets. Now, all assets except Arre Bapre, what is it? Why it is accepted? Because will the company balance sheet will have jewelry? No. Of course it will have. If the company is a jewelry company, okay, trading of jewelry, then jewelry will be there. So if jewelry is there, I will not take the book value. Book value is actually cost, historical cost. Then investment in shares and securities and immovable property. So jewelry, shares, securities and immovable property will not be at book value. Oh, for book value, what you will take? For book value, you will go to audited balance sheet. So if your asset doesn't have jewelry, if your asset doesn't have shares, securities and immovable property, better go to your chartered accountant, statutory auditor, get the balance sheet certified, audited, and then rule 11 UA matter khatam. What is it? Take all the book value of all assets. Okay. And if immovable property is there, my God, you have to take the stamp duty value in respect of immovable property. Okay. So with respect to jewelry, you have to take the open market value. Please look at this. That is why I use the word called kichidi. And with respect to shares and securities, it is fair market value. All wordings are there. You will actually go berserk. For assets other than jewelry, share securities, you will go for book value. Immovable property, stamp duty value. Shares and security, fair market value. Jewelry, open market value. And this open market value, again you need a valuation report obtained from a registered valuer. And who's a registered valuer? Registered valuer means those who find a place in section 34 AB of the Wealth Tax Act 1957. I told you 9,000 plus people are there all over India. From them you have to take. Open market on the basis of valuation report obtained for reason. What that gentleman will do, he will only take the newspaper or go to the website. Oh, on this particular day you want the valuation. What is the market price? What is the? He will weigh the number of grams, multiply. How many kalli is there? How many gold is there? Multiply. Then they will take it. That's all. And he'll give a certificate. That you have to take. So it is a kichidi. So people will go actually, why I should do all this stuff? So one side I have to take the audited balance sheet. One side I have to take the valuer's report. One side I have to take the stamp duty value. Okay, as on that particular date. Okay. So now please look at this. So the fair market value shall be the value as may be determined. Okay, as may be determined according to such method as may be prescribed. Now please look at your rule 11. For the purpose of section 56, the fair market value shall be determined. So where is 56 given? This is 56. Okay, this is 56. 56(2). Or as may be determined according to such method as may be prescribed. So that is your rule number 11 UA. For the purpose of 56, it shall be determined fair market value. So as may be fair market value, as may be determined, rule 11 UA. Okay. So rule 11 UA, it says valuation of shares and securities. I will go by B. Oh, very good. Now you need not worry about this this PV by P, paid up value of equity shares by total amount of paid up value equity share as shown in the balance sheet. If you have only one category, both are same. Okay, if you have one category, both are same, unless either you have a more than one category of equity shares. Okay. Now now very interesting now. Okay. Now please look at this section. As may be determined with such method as may be prescribed, or as may be substantiated by the company. Now I am not the picture abhi baki hai. I must say the picture abhi baki hai, because what the rule says, I will just take you to this particular rule. Please go back. This particular rule, C 11 UA1, valuation of shares and securities. A, fair market of quoted shares. B, fair market of unquoted equity shares. C, fair market of unquoted shares other than the equity shares in company which are not listed. Oh my God. Then B and C seems to be same. Okay. B and C seems to be same. So let me now show you that. What is C? The fair market value unquoted shares and securities other than equity shares in a company which are not listed in recognized stock exchange shall be estimated to be the price it would fetch in or sold in the open market on the valuation date, and the assessee may obtain a report from a merchant banker or an accountant in respect of which such valuation. Okay, so that means C, fair market value unquoted shares and such securities other than equity shares in a company which are not listed in a recognized stock exchange. That means again unlisted, unquoted shares, private limited. Okay, it shall be estimated it would fetch if sold in the open market on the valuation date, and the assessee may obtain a report from a merchant banker or accountant. I repeat, merchant banker or an accountant in respect of which such valuation. Now here I want all of you to pay your kind attention. Okay, please look at this bracket. This bracket is very important. So this is in italics. This is in italics. Okay. Now this section has been introduced. That is why this is in italics. Now what they say, notwithstanding anything contained in subclass B of class C of subrule 1. Notwithstanding anything contained in subclass B of class C of subrule 1. So what is subclass C? Subclass in that what is B? It is fair market value. Okay, good. So up to this, close. Now this is the place where they, please look at this. They have actually substituted this entire section, and one particular I just want to share with you this too. Please look at this. The similar wordings are here. So you already have what do you call it as A, B and C, and now they use they give a section called notwithstanding section. Now why the word notwithstanding section is given? Now here you say you go by the audited balance sheet, you go by the open market value, you go by stamp duty value. So the Kichidi method is there. Kichidi method is oh, should I have to go for the Kichidi method? People were reluctant. Okay, then go for C, fair market value of quoted shares. Okay, unquoted shares. You go by either valuation by a merchant banker or an accountant. Accountant means chartered accountant in respect of such valuation. Now this subsection C is still there for your information. Subsection C is still there, but for fair market value of unquoted shares other than equity shares in a company which are not listed in a recognized stock exchange. So meaning it is unquoted, unlisted, private limited companies, everybody. Okay, you still have the option under C. So that means I can go for a merchant banker or an accountant, but here what is the method they will adopt? Nothing is mentioned. That is why C seems to be very, I will call this as a very generic. And if at all a chartered accountant gives a certificate under C, will that be adopted? Answer is please wait, because method is not given there. So therefore C has a lacuna. That particular provision has a lacuna. So therefore this subsection subrule 2 has been brought out. 11 UA2 has been brought out, and that is why please look at 11 UA2 for the purpose of 11 UA2 balance sheet definition they have given in 11 U subclass B. So now please look at 11 UA2. Notwithstanding anything contained in B, the fair market value of unquoted equity shares for the purpose of 5627B. Okay, the fair market value as per the explanation, what is it? Subclass 1 of class A. Okay, what is subclass 1? of class A of explanation. Please look at this. Subclass 1 of class A of explanation. So I am in as may be determined in accordance such method. So for your kind information, I can either go by 11 UA 1 CB or notwithstanding anything contained in above, I can even go by this. Ignore that, go by this. Why ignore that? Ignore that means C has a lacuna because method is not prescribed. And here it is Khichdi method. So therefore, rather than deleting this section, they have given this particular, deleting that rule, they have given this rule. What is this rule? While giving this rule, so why the word notwithstanding is given? Ignore that. You want to go by that, go. Or ignore that and go by this. Okay. Then shall be the value on the valuation date of such equity, unquoted equity shares as determined the following manner under class A or class B at the option of the assessee. Here they are very clear. See, this class A or class B option, they are not clear here. Should I have to go by B or C? They are not clear. They could have actually given that. Actually, they could have deleted it. They could have totally deleted it. Instead of deleting it, they are given a clear rule. 11 UA2 clear rule. Class A or class B are the option of the assessee. After this, I'll go for a story. I'm going for a case law. All of you, I'm going for a case law. So all of you, please pay your kind attention. Now, so what is it? This A or B, I want your kind attention. All of you, please look at this. So this is your, this is B, A. Now, what I will do, I will just remove all this stuff. This is A and this is B. So please look at A and B. This is your B. And how you have to do the valuation, this same A minus L, asset minus liability, that's all. What is asset? Book value. Book value of assets in the balance sheet. Okay, that's all. Simple. So what is balance sheet date? I will go for the audited balance sheet. Either valuation date balance sheet or the immediately previous year end balance sheet. Very simple. So you put the responsibility on the chartered accountant. So if you go by rule number 11 UA2, select A or B. Now please remember, A or B are the option of the assessee. This word option of the assessee is not given above. Very important word. At the option of the assessee. Okay, very important word. So at the option of the assessee, I will choose A or B. Now please look at this A. A is very clear. Fair market value. Okay, I repeat, the fair market value is A minus L, asset minus liability. What is asset? Book value. What is liability? Again, book value. Please look at this. The book value of liabilities. So the book value of assets, book value of liabilities, matter over. That's all. Okay. Very simple. Now, fair market value. This A or B. So here also fair market value of unquoted equity shares determined by merchant banker. Wow. So here it is merchant banker. So the chartered, the accountant has been removed as per discounted free cash flow, DCF. As per discounted free cash flow. So therefore, if it is discounted free cash flow, it is merchant banker. If it is chartered accountant, it is audited balance sheet. Very simple. You want to go to merchant banker, he will do discounted cash flow. You want to go to chartered accountant, go for the audited balance sheet as on the valuation date, which is book value of asset, book value of liability, A minus, matter over, khatam. Okay. The only thing is certain things and all you should not consider in book value of assets, especially amount of tax paid and all. If you have put it in, because those are not assets at all. Those are all already paid. So these chiller item and all don't need to worry about it. Similarly, liabilities, you cannot consider paid up capital, all these things and all. A liability means a pure outside liability, not your internal liability to our shareholders. So all those jigna points and all we can ignore. Very simple. So chartered accountant or merchant banker. Merchant banker DCF method. Chartered accountant valuation date audited balance sheet. Okay, what is balance sheet here? So book value of the asset in the balance sheet. Okay, in the balance sheet. So here also liabilities in the balance sheet. So what is the balance sheet? My balance sheet is here rule 11 UB. For the purpose of rule 11 UA2, drawn up on the valuation date, audited by the auditor. No need to adopt a general body meeting. Get the signature, take the list minus the expenditure. Matter set. So this or that, the is the option of the assessment. That is called rule 11 UA2. Very simple. They made the provision very simple. Now previously, discounted cash flow also accountant was there. They removed it. So chartered accountant doing discounted cash flow, chartered accountant will give the fair market value. Now the same statutory auditor used to give the certificate also under discounted cash flow. That value was different, and the book value will be different. So book value means go to chartered accountant. That is the statutory auditor, not any chartered accountant. If you want the discounted cash flow, go to merchant bank. They have made it very clear. Okay, good. Now that means I cannot go to any other chartered accountant except the statutory auditor. Now coming to interesting questions. Okay, so we are now close to 7:20. I'll take another 10 minutes to share some of the interesting cases. Recent decisions, ICAI decisions. Rule 11 UA2A and Rule 11 UA2B. What is Rule 11 UA2A and 2B? Please look at this. Rule 11 UA2A is statutory auditor. Rule 11 UA2B is the merchant banker discounted cash flow. On this there is a case law. Recent ICAI decision. ICAI Jaipur bench. Date of order 9th October 2020. NAB Multi-Trade Private Limited Jaipur versus Income Tax Officer Ward 3 Jaipur. Now this is what I have here. Please all of you watch. So I think I have. This is it. This is that case, and I'll just share with you one interesting situation alone. 37,500 shares has to be issued. Face value 10. Okay. Issue price is 200. That means premium 190. Okay. So 190 is taxable. But what is the fair value? Fair value is actually given as 200 and some 200 and odd. 200 and odd. That is 230. The fair market value as determined by the registered value 230 per share based on market value of the assets of the company. Okay. Now here, fair market value is given by registered value. This is where the problem is. Then after that, so many jagada and all happen. I'm only taking you to the last para. Okay. I want all of your kind attention here. Kind attention. Okay. All whatever I discussed, they would have discussed here. It is observed that in the instant case, the assessee company has exercised an option. I repeat once again, the assessee has an option. What is the option? Either I'll go by fair market value. Actually, fair market value under 11 UA2A is book value only. Book value is under Income Tax Act is called fair market value for your kind information. And the discounted cash flow is also called as fair market value. That is why in Income Tax Act, whenever you read Companies Act, Insolvency Bankruptcy Code, and SEBI and Ind AS, don't compare that definition here, because Income Tax Act definition of fair market value, place to place it is different. Place to place different. As I told you, the fair market value for jewelry will be open market value. Fair market value for shares and securities is different. And fair market value for immovable property, stamp duty value. So this fair market value is not static. It actually takes, it is like avataram, different avataram it will take. This depending upon the circumstances, the fair market value avataram will change. Oh, is it first avataram, second avataram, third avataram? Okay, good. Now come back here. Come back here. So I had exercised an option to value the shares by DCF method. However, DCF method means who will give? Merchant banker will give. But however, we when AO has worked out the value based on NAV method. Can AO work based on NAV? So far we have seen the rule. Can assessing officer work under NAV method? No. The assessing officer cannot work under NAV. I have to only go by the statutory auditor's balance sheet, audited balance sheet, book value I have to take. That is fair market value, that is net asset value only. But that is audited balance sheet. Second, please look at this. Or as may be substantiated by the company to the satisfaction of the assessing officer. Assessing officer only to be satisfied. He cannot do calculation. Now who has to calculate? Company has to calculate. Company has to substantiate. Company has to. Now as may be substantiated by the company. So if I can go by rule or as may be substantiated. Now how will I substantiate? I will get the report from a registered valuer. I'll get a report from a chartered accountant. So if I have to go by the rule, I will go from a statutory auditor or DCF by the merchant banker. Now here, as may be substantiated by the company, I will go to a chartered accountant who is not a statutory auditor, ask him to give me a DCF valuation, which will be, and that will be treated as a fair market value because as may be substantiated. Does it say no, you cannot do it? Because it is company valuation. It is company valuation. The law doesn't stop you. Law doesn't stop you. I am not giving a valuation under 11 UA. I am not touching 11 UA at all. I'll directly say 56 subsection 2 7B as per external explanation A2. I've been engaged by the company to do the valuation. I am giving and I am at my free will to decide the method. Nowhere the method is given here. Because it is substantiated by the company to the satisfaction of the assessing officer. So he should give explanation. Now please look at this case. Though in the body of assessment order he has referred to rule 11 UA2B, but in substance he has valued the share on book value figure only, considering the assets and liabilities. The learned CIT also though considered 11 UA2B, yet however his act of asking the assessee and the CA to prepare and submit a valuation report on actual figures is nothing but a valuation done on NAV method under rule 11 UA2A. What is 2A? It is actually NAV method means, and his statutory auditor means what? It is an audited balance sheet. So from the facts, thus it is clear that authorities below wanted to impose upon the method of valuation of their own choice, which cannot be done because choice is only given to the assessee. It is not assessing officer's choice, it is assessee's choice. So therefore, accordingly, in view of the foregoing discussion, the addition, okay, that 180 rupees, sorry, that 190, that 200 minus that 190 rupees addition is to be this is actually deleted and the appeal of the assessee is allowed. Very interesting, guys. Very interesting. Okay. Now I'll take you to another 2-3 instances after this. Maybe 1 or 2 I will take instant. Then I'll leave the floor open for questions. Now please look at this. Where am I? Practical issues. This is one more case which I want to share with you, where the valuation report approved valuer submitted by assessee suffered some grave infirmity. Maybe the calculations are wrong, the assumptions doesn't satisfy with respect to the facts of the assessee. In as much as it did not take into account a number of items used by assessee for construction of property, AO can refer to the departmental valuation officer. Actually, this is a case with respect to 55A. That is with respect to capital gains. Okay. Now, in this particular case, reference to valuation officer is not possible. Okay, for your kind information, it can only be done by, and can income tax officer do his own calculation? No. He can only ask 2 things: give me the report either of the statutory auditor or of the merchant bank. That's all. There's only 2. So beyond that, nothing can happen. Maybe one more decision I will just share with you with respect to a similar aspect with respect to referring to a valuation officer, but this is with respect to capital asset. Okay. With respect to capital asset, I just want to share some of the interesting cases also, where there is nothing on record to show the assessee received consideration for sale of property in excess of which has been shown in the agreement to sell. Okay. Then the actual sale consideration recorded in the agreement to sell and received by the assessee could not be substantiated by the value as adopted by the district valuation officer or departmental valuation for the purpose of computation of capital gains. Okay. So all these are, so one thing we are very clear, reference to the valuation officer under 55A cannot happen with respect to the transaction discussed under 5627B. 5627B is the, I will call this the exclusive arena for chartered accountants. Okay. And where the best thing is the balance sheet will be audited as on the valuation date, best, or you can go for the balance sheet as per the drawn immediately preceding the valuation date, which has been approved and adopted in the annual general meeting. Now there will be an interesting question here. Drawn up as on a date immediately preceding the valuation date, which has been approved and adopted in the general meeting. Now I am in 17th of February 2021. Still 31st March 2020 is not adopted, approved and adopted. Can I take 31st March 2019? This is actually a very interesting question, but that will be too long, but you can take. But there can be a question from the assessing officer. Your valuation actually, if you go back, the more you go back, your valuation is going to be less only. So therefore, if you receive more money, department is only going to be benefited. So therefore, if you go back more than 1 year, the advantage is not for the assessee, it is only for the department. Okay. So I think some very good number of discussions I am sure I have put forth before you. But one thing, guys, I just want to conclude. Before I conclude, I just want to share one more last point. Valuation is picking up a lot, and I am sure in the days to come, already recognition has been given for professionals, due professionals under the Income Tax Act. But the only thing is there is no regulation, there is no regulator with respect to that. So there is a 100% confidence by the department on the valuer as of today, who has been listed out. So maybe the time is not far off where all the types of valuation will be brought under one umbrella, including Income Tax Act, and the Valuers Bill 2020, which was actually proposed, any time can be tabled. And in that there is a point that has been included, that 14 laws they may amend to bring the concept of registered valuer, okay, or the valuation professional. So they will only be considered as a unitary professional to actually give valuation for various kinds of assets. So I think with this, I will thank the Institute of Chartered Accountants of India, Southern India Regional Council, for giving me a wonderful opportunity to share my thoughts on Valuation and Income Tax Act. I will hand over back to the organizer, and any questions, I'll be eager.
Sure, sir. So thank you, sir. And I have compiled some questions which have came up. Okay, I'll just share my screen, sir. Okay, this is Selva here. 1 minute. I hope my Excel sheet is visible.
Yes,
sir, is it visible?
Oh yeah.
Okay. Sir. There are 5 questions here. This is the first one. It's a series of questions. Do you want me to read it out, sir, or else you will be reading it and giving it? And 1 minute. This one, first one, as per Rule 11 UE 1BB, register value for jewelry artistic work is value registered with IT department with respect
Well, the
to tax.
is right.
Yes.
Absolutely correct. Dehalison, Mr. Dehalison, your question number 1 is correct.
Yes. The next one is immovable property to be considered as sub-register will adopt for stamp duty purpose as a CA. Do I need to hire in engineer, not necessarily regular value 0
Register
IB?
value. Or can I
Or can I
look
look?
up the value table and state the value?
Yes.
So this is actually a very interesting question. Say 11 UA 1BD. Okay, so where they use a word called the value adopted or assessed or assessable by any authority of the government for the purpose of payment of stamp duty in respect of immovable property. That's all. They don't say any professional there. At least in B, they refer to registered valuer. Today, you get the guideline value even online. Okay, in online itself, you get the guideline value as on a particular date. You can take a screenshot and go ahead. So therefore, I don't see a necessity to hire a engineer or a registered valuer. Okay, you yourself can look up the guideline value table and go ahead. So your second part of the question is correct. Okay, good. Next one.
Third one is first provision to section 56 7B exempts VC fund and other companies as may be notified as those companies be notified whether startup registration under RDA PP enough to ensure that the tax is not slapped.
Yeah, it has been notified. It has been notified. So startup companies registered under DIPP, they have they are coming under this. So provided they satisfy those two criteria. One is they should have been approved and they should have got a number also. So in the income tax return form also both the things have been asked. So your point is absolutely correct, Mr. Dehalison. Next.
Okay, so how to empanel with IT department as valuer for WT tax purpose, though there is very limited scope, still would like to empanel.
Actually, you can do so. There is an application. There is a form number. I'm not sure if the form number is P. If I'm right, the form number is P. You can fill up that particular form and submit your form to as a chartered accountant. You can do as MBA or as a master's in commerce with 10 or 12 years of experience itself. They can give. So you can give your credentials, fill up that particular form, and give it to the respective director general or chief commissioner. They will actually enroll it. So as of now, the numbers are very less. Better to actually give an application. So there is no restriction for a chartered accountant. You can do so. Next question.
The second question is: this registration of CA under WT Act gives any scope for practice on income tax? CA Ravi Shankar Deva.
Actually, for a chartered accountant, I don't see a necessity to register under the Tax Act. Okay, maybe you want to have an experience of getting registered, you can do so, how the process happens, but I don't think there is a necessity. Okay, so without that itself, we have a lot of scope. And as a chartered accountant, you give your valuation of shares, it is actually taken on record. So that is actually given due credentials and due credit in the law itself has been already given. So you are actually open, but my view is it is not required. Next.
Third one, sir. Has any method been prescribed for valuation of issues of preference shares? Similarly, is value required for conversion?
No.
Compulsorily convertible debentures or preference shares. Okay. Fourth one, the share purchase agreement, share transfer date, and consideration settle date are different. Which date should be taken for balance sheet preparation? Can statutory auditor should issue limited review report for a balance sheet for valuation purpose instead of CARE report by CA Murali Krishna?
I think one. There I think two questions. Share purchase agreement, share transfer date, and consideration settle the date are different. Agreed. Which date should be taken for balance sheet purpose? There is an agreed date. Okay, share transfer date. There will be a date called share transfer date. I think that share transfer date is relevant. that will be mentioned in the purchase agreement itself. In the share purchase agreement, for example, today you are entering into an agreement, 17th of February, you have to make money ready. So you say on 31st March we will have the share transfer date. 31st March you do the valuation stuff, give, and you make a one token advance, make the balance payment. So the ultimate settlement takes actually 3-4 months or 6 months, but the share transfer date is relevant. Number one, and statutory auditor should issue limited review report for balance sheet for valuation purpose instead of CARO. There is no necessity for CARO. Number one, why you are giving CARO? So company's audit report order, I will say, which is only applicable once in a year. Because you are not going to present it for your shareholders. Okay, you are not going to present it for your shareholders. Of course, if you read that particular 11U, I have not read it fully. It says balance sheet including the notes annexed thereto and forming part of the accounts. It only says notes. It doesn't speak about any audit report. So you can give a, what do you call it, as limited engagement. Okay, this is a specific engagement. It is actually limited review. You can call it as limited review, specific engagement. So I don't think I don't feel there is a necessity to issue a CARO report.
Sure. So fifth question: compulsorily convertible preference shares with voting right, should it be considered as liability or can it be considered as equity? By C. Nitya Shankaran.
Nitya Shankaran is asking me an Ind AS 32 question. Okay. But anyhow, since the question has come, let me answer. Compulsorily convertible preference shares, you are going to convert it into equity. Okay, CCPS. Now, preference shares, redeemable preference shares, is, that means you are going to pay money, then it is a liability. If it is a compulsorily convertible preference shares, it is actually equity. So Nitya Shankaran, this is not a valuation question. Ind AS, you have the answer in Ind AS 32. Next question.
Last one, sir. Yes, sir. Please clarify with respect to FMV as on 1/4/2001. How do we get FMV certificate and who will issue the same? And also with respect to JD, how to consider the valuation of landowner share of properties?
Okay. Actually, it's a very good question. Srinivas Vaddi Garu, I must appreciate you for asking this question because I thought of keeping this in my discussion. Fair market value as on 1/4/2000. How do we get fair market value certificate? Who will issue this certificate? Wow. I'll give an example. Okay, example. 17 to 2021, you are making a sale today. The sale consideration is 250 lakhs, 2.5 crore. The property was purchased in 1980. Okay, the property is purchased in 1980. Construction and all happened in 1990. Okay. Now, sir, I show me that question here. So, mela ponga. So, on the question, yeah. Okay, right. Yapa.
1 minute, sir.
Question. So now you have done substantial development before 1st April 2001. Let us assume you know the cost. You know the cost. So up to 1995, you know the cost. You have borrowed loan, all the stuff and all. Assuming the SSC has some of the records, and he has invested in that properties. Let us say 28 lakhs. Okay, 28 lakhs he has invested over a period of time. Now 250 lakhs he has sold for it. Now 1/4/2001, if I know the cost, if I know the fair market value, I will do the, because otherwise 28 lakhs only I have to take it as 1/4/2001. From there only I have to do indexation. I want to know the fair market value 1/4/2001. 1/4/2001. Point number 1, point number 2. Section 55. I repeat, section 55 of the Income Tax Act. They are. I will just read that particular section alone. Okay, section 55. Now, what is section 55? Meaning of cost of acquisition. Meaning of cost of acquisition. In that, the they are making one point very clear. They are making one point very clear, that where the capital asset became the property of the assessee before 1st April, cost of acquisition of the asset to the assessee or the fair market value at the option of the assessee. Please, they are making this point very clear. So at the option of the assessee. Now who will give? So you engage a valuer, you give him the data first, for example, this land and building. So engage a land and building engineer, land and building valuer, and get a valuation report dated today, but valuation date is 1st April 2001. Now people have understood this. I'm not going to give a tax planning tip here. All of you, please. I'm going to make a tax planning point here. Okay. So property was sold in 17 to 2021. Now I'm taking the 1/4/2001. Instead of 28 lakhs cost, the fair market value was valued as 60 lakhs. From 60 lakhs, I will do the indexation. So my capital gains get reduced. Wow. Now there is a loophole here in this law. People can actually take the valuation report from land and building valuers. Okay. How to get the valuation report, all of you know. I need not tell. Okay. Now they have plugged this loophole saying that provided, and this is inserted from Finance Act 2020, applicable from 1/4/2021. Applicable 1/4/2021. So 1/4/2021 means April. Innu varle. Adutha maasam da. So applicable from, okay, with effect from 1/4/2021. Okay, Finance Act 2020. So point to be noted, this has come from Finance Act 2020, applicable from assessment year. Okay, so please understand this word, with effect from the date is 1/4/2021. It is not assessment year. With effect from 1/4/2021, what is the amendment they have made? Whatever may be the fair market value as on 1/4/2001, it shall not exceed the stamp duty value as on 1/4/2001. So now stamp duty value as on 1/4/2001 or the fair market value. If your fair market value is lesser than that given by your valuer, take that. I am very happy. You are going to pay more tax. Or stamp duty value, because the valuer will give the stamp duty value itself as the fair market value. So very good. So therefore nowadays getting the fair market, getting the stamp duty value as on 1/4/2001 is very significant. Okay, and that cost you also. Good. Next question. Maybe we'll take last 1 or 2 questions and then we'll close it. Aparamba.
Sure, so 1 minute. 1 minute. 1 minute. Just flash the slides.
Thank you very much for joining.
Sir, yes, joints and yes, candidate issue it seems, so it's going on and off. 1 minute. Is my Word document visible, sir?
Yeah.
No, I have no. There are only 2 questions. So these 3 last 2 questions. These 2. This one. In case of buyback, whether the set rules are applicable.
Of the said rules are applicable. As per income tax, whether any method is proposed. No method proposed. Okay. So buyback, whether any of the sub rules are applicable. So here, please read the provision very clearly. What it says, section 56, very clearly. Let me read the section 56 7B. Where a company, not being a company in which public are substantially interested, receives in any previous year, okay, from any person being a resident for issue of shares. So buyback of shares is not issue of shares. Okay. So therefore, 56 to 7B is not applicable. Next.
Can GAR be invoked and reject the valuation report of chartered accountant?
Last. I think very interesting question. This is I will call this as bulldozing. Bulldozing. Unless and otherwise, see in GARR, unless and otherwise you prove that there is a avoidance you have done, so it cannot be rejected. The chartered accountant certificate cannot be rejected. So there is a recognition given to an expert here. I will say like this. So GAR cannot reject a chartered accountant certificate. GAR, unless another associate does a action which is an avoidance action. Here, a chartered accountant valuation report where the value is given is final. And GAR cannot actually overrule a chartered accountant. It is an independent expert's report. How can GAR overrule it? It is not possible at all. Maybe let the department do one guy will go to court and will get a beautiful ruling upholding the integrity and the professional skill of a chartered accountant. Your question, I appreciate it, but GAR may be draconian, but it is not so draconian to overthrow a chartered accountant's valuation report. Okay, good.
The last one, sir. The company has invested partnership 51% of capital 3 years ago, and now they are retiring as partner. New partner coming as a partner in February 2021. Please guide on valuation of investment related rules by CA Murali.
This is section 45.4, 45.3, 4 and 4A question. Maybe this is a out of syllabus exam question you are asking, but anyhow, with this I will close my discussion. Yes. Here recently, okay, recently budget 2021 they have made one new amendment with 45.4. Whenever you reconstitute your partnership firm, especially your capital account, so whatever is your capital account, for example 40 lakhs is the outgoing partner's capital account. Is it partnership capital plus the accumulated profits? Then pay him cash, let him go. Now, instead of paying him cash, you are giving him some capital asset. Then, very important, then the fair market value of that capital asset, you would have got it. For example, for 40 lakhs, you are giving a particular vehicle. In your books of accounts, it will be 40 lakhs. So you say, okay, this vehicle you take BMW, but the market value of that BMW is 70 lakhs. So maybe if you have sold it, firm would have got 70 lakhs, and 30 lakhs firm will pay capital gains tax. So even if you give the 70 lakhs fair market worth of car for offsetting the capital account, capital gains will be there for the partnership firm. So that is the message you have to take from 45.4. I think that 45.4 alone, we need a minimum 1 hour to discuss with a lot of examples. I've just shared with you only 1 or 2 examples. Maybe with this, I must thank the Southern India Regional Council for giving me this wonderful opportunity. And special thanks to both the chairman, secretary, and regional council member C. Naresh Chandragali for being host for today and making this program a grand success, and all the 200+ participants who were virtually logged in the entire session. My thanks to all, each one of them. Thank you very much.
Thank you, sir. Thanks, sir. Naresh, sir, over to you, sir.
Yeah. So actually, friends, I think
it seems sir is having. Sir, are you hearing him, sir? It's breaking in between. It seems the bandwidth is a little bit on lower. Anyway, now you're connected, sir. Can you just check now?
Friends, to explain various questions income tax. It was a very interesting and enlightening subject for all.
Sir, am I audible? Oh, is hello? DK sir, is it audible?
No, you are audible, but he's not audible.
Naresh sir is not audible, right? So, sorry, sir. It seems he has a connectivity issue, and we thank you on behalf of SIRC, sir, on absence of our chairman, secretary, and our team, sir. Thank you very much, sir. Thank you. That closes one, sir.